In this video, we're going to be discussing the difference between two types of spread, the fixed spread and the variable spread. So every time that you trade, you will see a bid price and an ask price, otherwise known as the sell price and the buy price, depending on which way you want to phrase it. And obviously the difference between those two prices is called the spread. So if you're using a fixed spread broker, your spread will remain the same at all times, no matter how volatile the market is. So for example, if your broker is offering a 1 pip fixed spread and you're trading $1 per pip, you will need to make a 1 pip move into your direction, which will equate to that $1 in order to break even. At the same time, if you're trading $2 per pip, you still need to make that 1 pip movement, which will equate to $2 and so on. Variable spread is slightly different, and many brokers actually use variable spreads on their trading platform. The main difference here is that the spread changes according to market volatility. So spreads can widen or become a lot more wider when we get high volatility, and also if the market is really quiet, let's say on a Friday afternoon when nobody is trading. But during normal trading hours, when the market is at standard volatility, spreads don't really change much, but they do alter at various times of the day. Now, what you need to be careful of are brokers that use these high volatility times to hunt your stop. So for example, if some unexpected news comes out, we tend to see a huge market spike or a drop. And let's say, for example, we're looking at a really big market spike. At this time, some brokers will widen the spread out so much that your stop will get taken out. And they do this because they're at a very high risk of losing money if you trade in the correct way. So here they use their spread or the widening of the spread to guarantee that they make some money out of you. So they will probably call this risk management, but don't fall for this. Honest brokers don't do this, and there are plenty of good ones around. So let's look at this example here. So what we can see is a big drop in the market that starts from here and ends round about there. So obviously it looks like there's some news that's come out of the market that's affected the USD Japanese yen currency pair. So let's say that for the sake of the argument, we've entered the trade here at the top of this candle. Our stop loss would be just a few pips above as normal, and our target, let's say, is equivalent to this low here. So we entered here, our stop loss is here, and our target is here, that's equivalent to this low here. Now, if these were true market conditions and we've entered on this candle here, you can see that our stop loss has been taken out, and that's fair enough. It just basically shows that we've got the trade slightly wrong, and if we just got into it a little bit too early. So if we waited just a few kind of minutes after, then we would have, let's say we have an entry here, then we would have made our target quite easy. However, if these were untrue market conditions, then there's no reason for the market to spike upwards here. So if we entered there, we would fully expect the market to drop to this level here. And some brokers widen their spread so much that these unnecessary spikes in the opposite direction take stops out. And this is where traders can be treated unfairly. And the best way to kind of know if your broker is doing this against you is by simply comparing other brokerage accounts that you have. They don't have to be full of money. You don't have to upload loads of funds, but it may be worth getting another brokerage account to compare the two charts. And if they don't match, then you know that your broker is hunting your stop to take you out of the market, because that way they make more money out of you. So just be a little bit more careful and do a little bit more research and compare different brokers to make sure that these spikes occur in all of them, because if they only occur in yours, then your broker is trading against you and you need to quit that account. A list of approved Forex brokers. Now, each one of these brokers in our table has got a link to it to open a live account or to open a demo account. So realistically, it's up to you. Take your pick and just find out which broker is the right for you. If anything, you can open an account with any of these brokers just for comparison purposes. So then you can compare different broker charts to the ones that you currently have. So if you have spikes occurring in the market on your platform, it might be worth opening one of these accounts just to make sure that they also occur in other accounts as well, because if they only occur in yours, then you need to change your broker. Okay, so that concludes this lesson. As usual, if you would like to subscribe to us on our YouTube